Most traders believe their stop loss protects them. But for many traders, their stop loss is actually the reason they lose. Not because the market hunts stops, but because the stop reveals something uncomfortable. It reveals the trader, your fear, your ego, your need to be right. Your stop loss is not just a technical level. It is a psychological confession, and the market reads it easily, because millions of traders make the same mistake. They place stops based on emotion, not structure. Before examining stop placement, consider a question most traders avoid. When you place your stop loss, what are you actually protecting? Your capital or your prediction? Because for many traders, the stop is not placed where the trade becomes invalid. It is placed where the trader refuses to be wrong. A correct stop loss has only one purpose: to mark the exact point where the trade idea is proven incorrect. Not uncomfortable, incorrect. Many traders place extremely tight stop losses. They believe this is discipline. But often it is fear. Fear of losing money. Fear of being wrong. Fear of watching a trade move against them. So they place the stop just a few points away. But markets do not move in straight lines. Price breathes. It expands. It retraces. When stops are placed too close, normal price movement becomes a stop hunt. But the market did not hunt the trader. The trader placed the stop where fear allowed them to tolerate loss. Professional traders place stops outside structural noise. This usually means beyond the last swing high or low. Liquidity clusters, structural breakpoints. The stop must sit beyond where normal price fluctuation occurs. Now consider something uncomfortable. How far away is your typical stop loss? Not where your strategy says it should be, but where you feel comfortable placing it. Because many traders unknowingly place stops based on emotion, not structure. And when the stop is emotional, the trade was never objective to begin with. A useful rule professionals follow: first identify the structure. Only then calculate the risk size, never the other way around. If fear creates tight stops, ego creates wide ones. Many traders refuse to accept being wrong, so when price approaches their stop, they move it further away, then further again. Soon the stop no longer represents risk control. It becomes hope. At this stage, the stop loss is no longer protecting capital. It is protecting identity. The trader is not managing risk. They are defending their prediction. A valid stop must be decided before the trade is opened. Once price enters the trade, the stop never moves further away. It can only move closer to break even, into profit, never into deeper loss. But the deeper problem is not tight stops or wide stops. It is the assumption behind them. Many traders believe the stop loss exists to avoid loss. Professionals understand something different. A stop loss exists to define risk before the trade begins. If the stop distance feels emotionally uncomfortable, the position size is wrong, not the stop. One of the most common mistakes traders make is placing stops based on prediction. They choose a level where they believe price should not go. But markets do not respect beliefs. They respect liquidity and structure. The correct stop location is not where the trader feels safe. It is where the trade idea becomes invalid. Anything else is simply guessing. A practical rule traders can apply. Ask one question before entering. If price reaches this level, does the original setup still make sense? If the answer is no, that level is the stop. But prediction stops create another problem. They get hit often, not because the market is attacking the trader, but because the stop was placed in the wrong location. After several losses, something begins to change inside the trader. A new belief slowly forms. Now the pressure begins to escalate. A trader experiences several stopped trades. Frustration appears, then suspicion. Soon the trader begins believing something else. But this belief creates a dangerous cycle. The trader moves stops further away, or removes them entirely, and at that moment, risk becomes unlimited. The professional solution is different. They expect stops to be hit, because every strategy includes probability and loss. Stops are not failure. They are part of the statistical edge. There is another mistake most traders make. They place stops where everyone else places them, above equal highs, below obvious support. Near trend lines, everyone can see. These areas become clusters of liquidity, not because the market hunts traders, but because traders reveal their intentions in the same places. Professionals understand this, which is why price often moves through these zones before reversing. Instead of placing the stop on the obvious level, professionals place it beyond the liquidity sweep. Example logic. If everyone places stops below support, the correct stop is usually below the sweep of that support, not directly on it. Professional traders treat stop losses differently, not as emotional protection, but as mathematical boundaries. Before entering a trade, they ask one question: where does this trade idea become objectively wrong? That level becomes the stop. A professional stop follows three conditions. It sits beyond structural invalidation. It is decided before the trade begins. Position size is adjusted to respect that distance. Anything else is not risk management. It is negotiation with loss. Stop placement reveals how a trader thinks. Fearful traders place tight stops. Ego-driven traders place wide ones. Hopeful traders remove them entirely, which means something uncomfortable. Improving your stop placement is not just technical improvement. It requires psychological honesty, because the trader must accept loss before entering the trade. Professional trading desks sometimes ask a simple question. If your stop loss is hit, can you accept the loss calmly? Or do you feel the need to move it? If the answer is no, the stop was never realistic to begin with, because a stop loss only works if the trader respects it. When a stop loss is placed correctly, something interesting happens. The market loses its ability to intimidate the trader, because the outcome of the trade was already accepted, before the trade even began. And this is where many traders misunderstand risk. A stop loss is not protection from the market. It is protection from yourself. Most traders never realize this, which is why their stop loss continues to betray them. Not because the market hunted them, but because the stop revealed something they were not ready to see. If this shifted how you think about trading, the next principle will increase your profitability. Subscribe to continue the training.